What's going on YouTube? Welcome back to Trescence TV. Tonight I am doing new agent training. We are going to cover the IUL presentation, the Index Universal Life presentation. I'm going to work with one or two companies here, go through how I present to my clients and propose the IUL to them, go over their goals and kind of things like that. So I hope this helps you if you're a new agent, experienced agent, learning how to do the IULs. I hope this helps you out. And I'll be able to share my screen with you guys as well. So that'll pop up here soon so you guys can see that. So excuse my background, in a new office, haven't got drywall or kind of design plans yet. So it's just the studs and electrical wires behind me. So just ignore that and stay tuned. Hopefully this will help you guys out. Let's see here. So tonight I kind of wanted to, if you guys don't know me, I'm Trey Brooks, direct to Aaron Guterman. I'll share my screen with you guys here real quick. I'll start off with my PowerPoint that I use. I use this PowerPoint if I know their main goal and focus is for a tax-free retirement. So I use this PowerPoint to kind of help walk through, paint the idea, paint the picture in their head of how much money they need for retirement, how much money they need to put aside each month to hit that target. And it paints the picture if they do have 401k, if they do have IRA, how much money that they have or will have by retirement, is that going to be enough or not enough? So that helps them to kind of put some gas on the fire, go ahead and get an IUL, get that started for the supplemental retirement plan. So this is my PowerPoint that I've kind of come up with, kind of help me keep on track with what questions to ask when I'm going through my IUL presentation. Put this together just to help myself walk through people who want focused on retirement to kind of compare with some other retirement products. So I saw pretty much the same as the regular mortgage protection. Kind of have notes down here. So I'll ask them what kind of got them interested, what they already know about the IUL, kind of so I know what to talk about, what to focus on most, and kind of what their key points are with the IUL. Things, they're hot buttons. So hot buttons are important to push because that will ultimately lead you to a sale. It'll open up conversation more to answer more questions and have a good meeting with your client. Like I said, lead it off the same way as mortgage protection. I do a quick about me phase, about me slide. Don't read all of it. I just go through, touch some things on about myself, why I kind of got into doing this, just to kind of build that rapport. So this is my first meat and potatoes slide, a retirement account and a pension. Zach, you're going to be my guinea pig here. So you can just keep your mic off mute because I'll ask you a couple questions. But Zach, starting off, I'm going to pretend like you're my client here. You obviously want to grow a tax-free retirement. That's why we're meeting today. But Zach, do you know the difference between a retirement account and a pension account?
I actually do not.
Ooh, most people don't know the difference. So the difference between a retirement account is like your 401ks, your IRAs, your Roth IRAs, and your 403bs. Those will accumulate a certain amount of cash, and then whatever is in there will last until it's drained out. So if you have $100,000 in there, if you took out 10,000 per year, that's only going to last for 10 years. The difference between a pension-like account, which would be a company pension or government pension, and if designed properly, an IUL and a fixed index annuity will work like a pension. So the difference is that income will last forever. So we can design it so you pull out money that will last forever through the rest of your lifetime. So painting the picture is you could run out of money if you just had that retirement account. Like I said, if you only had 300,000, 400, $500,000 in there, then after so many years you pulling out your income, that's going to run out. What we like to prevent with an IUL or a fixed index annuity is to get that money to last forever. So even if you live till age 80, 85, 90, you still have that income coming in and you're not relying on your family to take care of bills and other expenses. Does that make sense, Zach?
Oh yeah, that sounds way better.
Cool. Cool. So just wanted to make sure that we were on the same page. And actually, 46% of Americans are actually worried that they won't have enough money through retirement. So I don't know if that's you, Zach, but it's definitely a lot of us out here. I was one of them until I kind of got my first IUL there. Moving on to how much I need to retire. So this chart is actually pretty accurate. So I'll go in, ask what they do for work, kind of figure out what ballpark range they are for their income. Normally, most families are anywhere between the 60 to 100,000. And you have, I believe this is based off a 20-year retirement. This is how much money they would need in their retirement accounts to be able to retire and to keep the same level of lifestyle. Now, this does not count for inflation. This is just to keep maintaining their after-tax income. So this kind of paints a picture in their head of, oh, I really need to get on the gas of how much money I need for retirement. So Zach, if you make $70,000 a year, if you want to retire at age 65, you're going to need 1.75 million in retirement income. Do you feel like your 401k or IRA will get you there, or do you think you're going to have that much by the time you get to 65?
Uh, no, I don't think so.
Cool. Yeah, so hopefully we can help you out here with the IUL. We'll kind of set that up to give you that supplemental income for retirement, so you could definitely get there, so you can retire younger. I do know my company's hiring if you wanted a side job that could help get you there a little bit faster, but hopefully this IUL could kind of take care of that for you. But yeah, so based on that 70K income, Zach, you're definitely going to need about 1.75 million to continue your current lifestyle without upgrading anything. And this doesn't really account for inflation, so you might need a little bit more, but this is at least how much you're going to need. Does that kind of make sense?
Oh yeah.
Cool. And before we kind of get here, I'll also go over their 401 if they have 401ks or IRAs about how much they think they have in there, so I know how to adjust this number. So if they already have, let's say, 50 or 500,000 in there, then I know we need to get to 1.25 million. Does that make sense for everybody so far?
Yeah, that's tremendous. That's good stuff.
Break this. Sorry, I'm trying to make it so I can see you guys better. Well, that's just how it'll be. So that's how I'll go over this slide here. Again, this is for people who are looking for supplement their retirement with an IUL. This slide I use kind of like a pacing slide to kind of set myself up. So Zach, would you rather pay taxes today or pay taxes for taxes 20 years from now?
Oh, definitely 20 years from now.
See, you got to be careful because that's a trick question. Taxes today are pretty high, right?
Sure, sure.
Do you think taxes are higher today or were they higher 20 years ago?
Oh, they're higher today than they were
Right.
20 years.
So 20 years from now, do you think taxes are going to be even higher or lower?
Oh, they're going to be higher.
Right. So that's why I'm not a real big fan of Roth IRAs. They do have their time and place, same with other IRAs, but those are accounts where they let you defer those taxes way off into the future. You're actually going to be paying more taxes when that future time comes because taxes have always gone up forever. And that kind of transitions me to some of the benefits about the IUL is that when you access that capital in your cash value, you get that tax-free retirement while you're building that capital up. You get living benefits, so that covers your heart attack, stroke, cancer, kidney failure, things like that. If you were to get seriously sick, you can access the death benefit while you're alive and still let that cash value grow. You also get great growth, normally between 6 and 10%, and we have some strategies that will get a little bit higher, but for the most part, you're going to be 6 to 10%. And then we'll talk about how you're protected from market downside as well. And Zach, how old are you?
I'm 27 going on 28.
27, great. So this last one is super important for both of us. Since we're both under age 59 and a half, if we got money from our 401k or our IRA, we're not only gonna have to pay taxes, but we're also gonna have to pay a 10% age penalty as well. So that's gonna bump up, or that's gonna change drastically how much you have to pull out, and you're gonna have to pay taxes and fees on top of that. With the IUL, taking out policy loans, there are no age restrictions, there are no taxes on that. So you get access to that capital tax free, grows between 6 and 10%. And again, there's no age restriction. So 5 years from now, you say, hey, Trey, I need to get $10,000 out of my IUL so I can go buy a house, so I can go buy a car, so I can go invest into this business. You can do that. Matter of fact, you don't even have to call me, Zach. You can just log right into your portal, request your money, and it'll get sent to you. Does that kind of make sense?
That sounds real nice.
Cool, right? So let's jump over here, Zach. Obviously, I know this is a great product. It has tons of great benefits, but unfortunately, not everybody qualifies. So let's kind of make sure that we can qualify. I just want to go back over the information you already told me. And again, guys, normally I already have all their current life insurance policies. I already know if they have 401k and retirement plans already because I kind of asked those questions up on these slides here. I was asking for, do you have anything that works like life insurance or any retirement accounts? And that's normally where this will come out. So you'll see that question again here, but I've normally already asked that and have it written down on my client sheet. If you guys aren't using these client sheets here, my camera has the filter on. But anyways, if you guys aren't using the client sheets, it has the name, first name, mortgage amount, and their health issues. I write all of my notes in detail on the back of that sheet when I'm talking to my client, so I know kind of how to transition and what to talk about. Or if we have to follow up, I know what we talked about and kind of go forward from there. That's what a professional does, so I highly advise you keep those notes as well. Again, we'll go over income. Zach, I already know you make 70,000. You work at this great company called TLG. Your first year, you're going to crush it. And we need about 1.25 million in retirement at 65. Now, you guys should get the medication medical history on that very first call when you set your appointment. I like to re-go over that information now. Zach, you told me you're pretty healthy. You've never had a heart attack, stroke, cancer. Is that still right?
Still correct?
Cool. Any diabetes, COPD, or high blood pressure?
No, sir.
Okay, great. So that sounds pretty good. I just have a couple other questions to make sure we can qualify. Any maybe DUIs in the past 5 years or any felonies?
No, thankfully not.
Cool, cool. So that that's about it for how I could qualify you. We won't really know if you qualify until we request for that approval. So once we go through the illustration next, kind of show you that cash value. If you feel like something like this would help you, we can request for that approval, and that's kind of when we'll know if you do qualify. Does that make sense?
Hmm.
Let's kind of jump over here and kind of figure out what this would look like for your scenario so we can see that cash value. And that's when I'll transition to either my company to F&G, America, or Mutual of Omaha to show them the illustration. So I'm going through the appointment. So I'll put in their name, Zach Markham. You said 27, right, Zach?
Yes, sir. 27.
What was that? April 8th, April 9th,
April 7th. Close.
7th, 1997?
Yes, sir.
And you're West Virginia, correct?
That's it.
Cool. So that's all the information I kind of need right now to show you that illustration. There's a couple ways to set this up as well, kind of depending on your strategy here. Um, I'll start this off. Do you know how much you were kind of looking to invest per month?
Let's say 200, $300.
Okay, let's start at that lower end, $200. Most of my clients, anyways, are doing anywhere between 150, 300, 400, $500 a month. I think that's a good spot for you based upon your income and where we need to go. So let's start off at 200. And again, we can always adjust that up or down. Does that make sense?
Hmm.
Okay, go through disbursements. You guys don't really need to do anything on disbursements. This is taking out policy loans. The only time you need to do anything on this page is if you are showing them what becoming your own bank looks like, taking out a policy loan, the cash value will replenish itself, and things like that. But we'll skip this page for now. Index strategy, we skipped this for the first time, but we'll go back to it. I'll touch base on it once the illustration actually pops up. This page is super important, policy options. So if they are under age 50 to 55, you're going to want to play around with this and double check each time, but you're going to want to change this death benefit option. This is something you can't do with Easy Solve, and this is super important. So you want to change this to increasing, hit this little calendar, change it to age, change it to about their retirement age. So you can do 65 or 67, or if you talk to your client and they say they want to retire at 70, change it to 70, whatever that retirement age is. And then from that next age to max, you want to add level. So what this does is it adds the cash value to the death benefit. So let's say they don't use any of the cash value, they get both of the cash the accounts. If they use the cash value and the death benefit, their family still gets both accounts. So what happens is their money goes into the IUL. Some of the money pays for the death benefit. Some of the money goes to the cash value. When you set it up for increasing, it essentially will lower the cost of insurance in the beginning and help increase how much cash value they gain by adding the cash value to the death benefit. So the death benefit is going to start low and grow over time, allowing them to pull out more money in retirement as well. So that's something I like to change and stress upon that point because it's super important. But we'll see what that looks like here once we get to the actual illustration. Don't need to change anything else. Now, if they're doing a 1035 exchange, this is where you put that in. That's if they already have an IUL or a non-qualified fund that they're going to put money in here as well. Don't really change any of the riders. Now, you can go in and add accidental if you want to get the target premium up. But if you guys notice, set it up first at target premium. And I'll talk to Zach here in a little bit on what his strategy is going to be. And that will make it so if we need to adjust it from target premium or if we need to adjust it to maximum funded premium, which we'll touch on that here once we see the actual illustration. So policy riders, don't need to do anything there. Ports, nothing there. My agent info is saved, so I would highly recommend you save that so you don't have to do it every time. And then you click calculate up here in the top right corner. Does anyone have any questions so far on what we've covered?
Trey, Mark Burns. I have a quick question.
Go for it, Mark.
I used to wholesale for IMOs, and I sold a lot of fixed index annuities. Do you guys use like a third party software to like compare the carriers that we represent, or just from your experience, you just represent using, I think you said Americo, Mutual of Omaha, and F&G. I was just curious as to like when you're designing, I know it's time in the saddle. I mean, are those just the three products I just need to kind of focus on, or does there other
Yeah, so for
products?
annuities as well, we use a company called American Equity. That's normally they're primarily an annuity company. Now, Mutual of Omaha and F&G do annuities, but if I'm writing an annuity, I'm normally going to go through American Equity.
Okay,
So
and now
great
as
for us.
far as IULs, when let's say like all right, say for example, I'm 51 years old and I'd like to buy an IUL policy.
Yep.
Would you just based on your say I don't have the experience you have, but like all right, I've done the case, I've got the facts. Where like all right, I've got all the information from the potential client. Are you going to like each carrier, or do you go into like a third part or like a neutral area and just punch in the data and it spits out the top three carriers?
Great question. So first, always report back to your upline, your case information with your client,
Okay.
and Nelson will be able to direct you to which company has the highest chance of approval and what's going to be the best fit for that client based upon their age, their goal, and their medical history. From doing this for a little over a year and primarily specializing it, Mutual of Omaha is normally your go-to. Now, in this situation here, where I um, got this little yellow exclamation point, he's going to be
Mhm.
okay. But if he was doing like four, 500, $600 at a young age, we might going to have to go to F&G just because this caps out at 300,000. Now,
Got it.
Americo is a potential as well because it caps out at 450. But I would utilize your upline because I do have that experience and they'll be able to guide you pretty quickly. There's a software called Toolkits that we use for that preliminary underwriting that you can punch all that information in. But your upline already pays for it and has it, so I would just recommend using them to kind of get that information. Does that help you?
Yeah, Trey, I appreciate your time. Thank you.
Hey, Carol, go ahead.
You're muted, Carol.
Bottom left button, microphone button. There you go.
Yeah, it was asking me if the host, anyways. It's a very great training. Thank you so much, Trey. Is there a time where you do not want to offer an IUL to a client?
Um,
Also, is
yep.
there a reason why you like IUL so much?
Yeah, so I'll answer most of those questions here. In the situation where, let's say a client is, let's use that same age, let's use 55 for an age. The cost of insurance is going to be kind of high. And if they have a low budget for the IUL, then it's probably not going to be a good fit for them because back to my cheesy drawing, I use this drawing all the time with my clients because it's so effective, even though it's super cheesy. Back to this cheesy drawing, you got your death benefit and your cash value. since we're a little bit older, since we're 55 and we only have, let's say, a $50 budget a month, most of that money is going to be going to this death benefit side. We're not going to get that much cash value, if any. So I would recommend transitioning. I would look at a term product or maybe a whole life, or if it was more important to get that permanent death benefit, then it could be a fit. But if they're looking for that cash value growth, then it's not going to happen with these two numbers here.
Okay. Thank
Makes
you.
sense. And then reason why I like IULs is actually why I got into life insurance. Bought my first one when I was 24. So I've always been super interested in the IULs, investing in real estate, building the cash value side. So it's just easy for me to have those conversations with my clients because that's kind of what got me interested in doing life insurance in general. So that's why I personally like it. It's just always had my interest, and then it's just been easy for me to talk with and kind of study all these pages here as well. So what happens is you click on this little PDF right here, and that opens up your illustration. Really 3 or 4 pages that I really touch base on. I make a joke in the beginning. I start off, hey Zach, this first part's going to be kind of boring. We're going to kind of focus on the actual insurance side of it. I know that's not what you really want to hear, but I like to cover it because it is super important for you and your family to kind of understand and know this. So all I did, Zach, was put in your first and last name and put in your birthday. And then here's my information here. You already have my license number as I sent it to you before we met, but here it is again, just so you know it's there. Moving down here to the second page. So this is going to be about it for the kind of the boring insurance talk, which is cool. That $200 investment is going to do pretty good for you here. That gives you the maximum $300,000 death benefit without a medical exam. So you get the maximum without having to do a medical exam, which is phenomenal. That's really good. We can kind of adjust that if we need to, just depending on how this cash value growth looks to you and your strategy, but we'll talk about that later down here. The other important insurance part of this is this critical, terminal, and chronic illness. So what that means, Zach, if you ever get a heart attack, stroke, cancer, kidney failure, anything like that, anything serious like that, you can use this $300,000 while you're still alive to pay for your medical bills, to pay for your mortgage, to pay for that truck payment, kind of take care of things in life while you're sick and you can't work. Does that make sense?
Yeah.
So kind of boring. I know nobody wants to pass away, talk about death and stuff, but that stuff's super important because you have access to that 300,000 before you pass away. So that's kind of how this is different from like your regular life insurance. So guys, I'll say that phrase to separate what I'm selling and showing them from maybe another agent who didn't touch base on this chronic, critical, and terminal illness that's included for free for the client. So that's how we can separate it from a regular life insurance policy that they know in their head that like life insurance is just death insurance, and this is how you can use it while you're alive in one way. Second, Zach, we still have that cash value that you can use while you're alive. So let's go down here. Let's kind of talk about the cash value. Zach, so are you familiar with any investing at all?
Small things here and there, penny stocks, but nothing quite like this.
Cool. So a little bit of the stock market. Have you ever heard of the S&P 500?
Yeah.
Cool. So what this chart shows here, Zach, is the S&P 500 annual return from 2004 all the way to 2023. And so what I want to talk about is earlier when I said you're protected from market downside. So what that means is we all know what happened in 2008, right? The market lost about 40%. So if you had $1 million in your 401k, your IRA, whatever it was in the market, you would have lost about $400,000. If that same $1 million was in the IUL, you would have lost $0. Does that make sense?
Yeah. Wow.
So this is the account that follows the S&P 500. So it again happened in 2022. So I know a bunch of my older coworkers that were going to retire in 2022, but their 401k took such a hit, 20%. So if you had 2 million, you lost 400,000. If you had 1 million, you lost 200,000. They would have had their money in the IUL. They would have lost 0%. And then all the other years, you get normal upside, great return of 9.25%. Does that make sense?
Yeah.
So this follows the S&P 500. Now, if let's say the market does not bad but not great, you're going to get exactly what the market does in this account. So like 2007, you had 3.5% return, which again, not great, but you didn't lose any money. Now, Zach, you might be thinking, well, 9.5%, I can make more money at TLG buying leads than that. How can I get more than 9.5%? So Zach, for some of my clients who have a little bit more time and can tolerate a little bit more risk, here's what I would recommend. So you could put half of your money here. So going back to this drawing, one more time, the cheesy drawing, you got death benefit over here. We know that's 300K. Then you have cash value over here. So on this cash value side, we can again split that bucket into two different tiers. So we can go 50% S&P 500, and then we can do the other 50% over here with Bank of America. Now, I recommend this account because it is uncapped. So you can see you get those big upside swings, 20%, 17%, 8%, 18%, 12, 24%, 28%. So the reason why I say split it, Zach, is because the Bank of America, you get those big upswings, those changes for those big upswings. But with this S&P account over here, it's pretty consistent. So that's why I say don't put all your eggs over in that Bank of America because it's a little bit less consistent than the S&P 500. S&P 500 is super consistent at getting that 9.25% return. Does that make sense?
Yeah. Yeah.
Cool. So we can adjust that later on if you want to. That's kind of my thought on how you should split it. You don't have to do 50-50. You can do 75-25, 60-40, any split you want. That was just 50-50 was just a hypothetical. Make sense though?
Strong presentation.
So biggest thing on this page, Zach, is you're protected from market downside and you can still get those big upswings in the market to kind of grow that retirement account. But let's go down here, Zach, and talk about the actual cash value and show how you can kind of use that for your retirement. So far, Zach, do you have any questions on what we kind of covered so far about the IUL? What are you kind of thinking?
No, just paying attention, learning as I go.
Cool. Yeah, it's a great product. Again, we'll kind of talk about those qualifications here in a second, make sure we can qualify for this. I know it's pretty great. But we'll talk about that here. But two more things I kind of want to touch base on with you is we got 3 accounts here, so you don't have to pay attention to this whole page. There's only really one column you need to pay attention to is this non-guaranteed. So this non-guaranteed cash value right here is illustrated at about a 6% return, which is about what you're going to receive. You're going to be somewhere between 6 and 10% on average. This account here is at 3.75, which is pretty low. And then this guaranteed's at 0%, which maybe if we went into World War III, the economy collapsed, something, then you might get that return, but it's probably not going to happen as you just saw past 20 years. You never got more than 1 or 2 zeros in a row. Same with that 3.75%. So we're going to focus on this non-guaranteed side because that's what's more realistic. Does that make sense?
Mm-hmm.
Cool. So Zach, like I said earlier, that starting out death benefit, this was set up at $300,000, $200 a month invested. That death benefit is going to grow over time. So how that happens is each year your cash value gets directly added to that death benefit. So if you never use this cash value over here, let's say you live till age 80, you never use that cash value. You never use that cash value here at age 80, you'd have about $473,000 in cash value, and your death benefit would be about $549,000. So you would get all that put together. So your family would get both of those accounts. Now, if you use that cash value, then obviously your death benefit would be a little bit lower, and we'll touch base on that when we take out some policy loans and stuff. Does that make sense?
Mm-hmm.
But I have it growing till about age 65 or 67. That's when it'll stop growing and level out. So your cash value will eventually catch up to it, to your death benefit. But the reason for that is it allows you to grow more cash value while you're younger, and take advantage of the benefits of this policy. So if you want to take out a policy loan quicker, you could. Does that make sense?
Mm-hmm.
Now, guys, on this screen here, this surrender value is their available loan balance. So in this scenario, he's paying for quite a lot of insurance. So his first 3 years, he wouldn't be able to take a policy loan out. That fourth year, he would. And this normally matches that cash value, the accumulation account, by year 15 or 16. They get to be about the same. So this one looks like year 15. They finally caught up to each other and they're the same. So that's kind of what to look out for. Now, the more they invest, so we'll touch base on this here in a second when I redo the illustration. The more they invest, the faster this will catch up in these first 3 years, and they can take out a policy loan sooner. But it always catches up around 15, 16, 17 to match those two accounts. So that's the available balance that they can take their loans from. So if Zach took out a 20,000 loan right here, this account would drop to 22,000. Their cash value is still going to grow at 42,000, and their death benefit is going to drop to 322. Does that make sense?
Mm-hmm.
So their money still compounds like they never took money out, but their available loan balance drops and their death benefit drops because if they never paid back the loan, you don't have to pay back the loan. They just subtract it from your death benefit. Make sense?
That's gnarly.
I'll illustrate that so you guys can see the actual numbers coming out. That's back on that disbursement page. I'll go back so you guys can see that. But again, you don't really have to get that detailed into it. But hitting those first 3 pages and talking about the cash value growth is for most clients all you really need to do to build that up. Now, another thing I always do like to do. Go ahead, Carol.
Thank you. Question. Can someone have multiple IULs?
Great question. So, yes, and kind of no. It depends. So, with the same company, Zach can only get $300,000 worth of death benefit without doing a medical exam. So, if we set him up with this 300,000 and he wanted to do another one for himself, then he'd most likely have to get a medical exam done to get that second one put in place. But if we did Mutual of Omaha, we did Americo, and we did F&G, and we stayed underneath those limits for the medical exam, he could have 50 of them if he wants to. So each company is a little bit different on their maximum death benefit coverage, but that just goes back to it being an express, which means no medical exam. Make sense?
Thank you.
Yep, of course. The last thing I touch on, normally I'll go in, of course, if we're doing back on the retirement, we see that we have $236,000 for retirement. Obviously, we need to get to 1.25 million, so that's not enough. But here's the cool thing about the IULs Act is that it's pretty flexible with that payment. So you have limits each year, a minimum and a maximum on this page right here. This minimum pretty much just keeps your policy in force. You're not going to get much cash value growth, so I definitely would recommend staying away from this number. The more years you can get to this $10,774 invested per year, the more cash value you're going to have, the more money you're going to be able to take out tomorrow, the more money that will be available for your family as well. So I'll kind of show what that looks like so you can kind of get an idea of how much money that is per month invested. Now, you don't have to do this every month. Most of my clients are just doing part of their tax returns, maybe Christmas money, work bonuses, kind of things like that. When they get extra money in, they just put it back to their IUL, put it into that bank account that they got with that cash value, and let it grow with great compound interest. Does that make sense, Zach?
Yeah, it does.
Okay, so let me get my calculator because my phone's up here recording. Okay, so I'll do this. 10,734 divided by 12 equals 894. So $894.50 is the maximum they're allowed to pay per month permanently without maxing out their IUL and going over that tax threshold. So Zach, if you're like, hey, I could probably do like $20,000 a year, we'd probably leave this company and go to a different company just because you're going to be well over their limits. Because again, we can't adjust the death benefit, and the death benefit is directly correlated with this number here. So the higher the death benefit, the higher that maximum is. But the maximum you could do is $894 a year. So I'll kind of show you what that cash value growth looks like for those years that you can hit it, so you know exactly kind of where you're going to look like coming to retirement. Does that make sense?
Mm-hmm. I have a question.
Yep.
As policy owner, could we borrow against the cash value if we needed to say a loan.
Yes. So as a policy owner, even if you're the policy owner of your kid's policy, if you're the policy owner of your wife's policy, if you're the policy owner of your policy, you will always have access to your cash value, depending on how much cash value is in there. So going back to show them, was that good?
Yeah.
Cool. So going back, guys, to show the illustration, to show them what the maximum cash value growth looks like for their scenario, you go back in, solve for no solve, put the same death benefit in that it ran the first time, and then you put that maximum payment of 894.5. So now this will illustrate the cash value of it maxed out on what they can accomplish. So, Zach, do you feel like you would just stay at that $200 payment, or do you feel like some months you could do more than that $200?
I believe some months we could do more.
Okay, perfect. Okay, guys. So if they say that they feel like they can invest more than their $150 a month, $200 a month, whatever number they said and picked was comfortable for their budget, they feel like they can do that, set it up at target. So set this back up when you're writing your thing, set it up at target. You're going to get paid the most. It gives them the opportunity to invest more into the policy, and your AP count's higher, your target premium's higher, your issue paid is higher. Now, if they say, Zach's like, no, probably never do more than $200 a month or $2,400 a year. To do your client a favor, you want to put it at maximum funded premium. So what this does is, back to this drawing, this being on maximum funded premium lowers the death benefit to the very, very bottom for the tax purposes, and this will allow the cash value to grow to the max. So it will spit me out a new death benefit that's going to be the very bottom. It's probably going to be like 40,000, 50,000, something like that. But I'm illustrating that to them when I have it designed like this on the no solve, showing them the maximum like this. So this is the same scenario. It's just showing what the maximum payment is to match that death benefit. So if you set it up at the maximum funded, it does it automatically for you. But no, if you do it that way, you're going to get paid less, one. Two, they can never put more money in than whatever you set up their monthly payment as. Does that make sense? That's super, super important. So that's the difference between setting it up at target and a max funded. So again, target allows them to overinvest into it if they can. So I frame it as this. Zach, I know $894 is a lot, so I recommend most of my clients start with something more affordable, like you said, $200-300. In those months you can do $900, go right ahead and do it. You don't have to tell me. You can invest straight into it. Because I mean, if I had that big $900 payment and an emergency popped up, I'm probably gonna have to pay for that emergency and skip out this policy. But if that payment was only $200, then I have that room and flexibility. So those months that you can invest more, definitely do it. That's how mine's set up. That's how my sister's is set up. So you don't really have that big payment. Now, if you're only going to do $200, then set them up at maximum funded. They're never going to invest more than that $200. Does that make sense? I want to make sure that's super, super clear. That's how I catch a lot of IULs and steal a lot of business from other agents because they're set up wrong.
Right.
So I want to make sure that's clear. So this setup right here is just showing what it would look like if Zach did overinvest past his $200 to the maximum. So he could do 300, 400, 500, 600, anywhere between 200 and this 894, 550. So anywhere between there is good, not over per year. Anywhere between, if he goes over, you're going to pay taxes. So stress that to your clients as well. So same thing, we'll go back into the illustration. Wait for it to calculate. So normally sometimes this takes a while. So I'm just, again, building rapport with my clients, talking about on my client sheet, kind of who that generational wealth would go to, their hobbies, their goals, kind of things like that, picking their brain, kind of seeing what they're feeling like so I know if I can move in for a close, if I'm going to reach any objections or not. So jump back in here. We've already gone over all of this. So I jump straight back to the cash value. And Zach, again, I'll say this to my clients, the only thing I changed was your death benefit stayed the same, and we changed the payment from 200 to the maximum. Make sense? So now you see this cash value is growing a whole lot faster, way faster than before. You can take policy loans out a lot sooner as well. And that death benefit is growing a lot faster as well, because that cash value, again, is always being added to that death benefit. Does that make sense, Zach?
Oh yeah.
Cool. So let's jump back here. I know we were focused on retirement, age 65, 67. Look at that. Perfect. If you want to retire at age 65, if you were able to max out your IUL, you'd have 2.72 million, which is actually more than enough because of infinite banking. If you wait till age 67, you'd have about 1.4 million and a $1.7 million death benefit. Pretty good, right?
Yeah, that's nice.
And you can access this money tax-free too, which is the best part.
The best part.
Normally from here, I'll go in again, ask how they're feeling. Is there anything else that I can kind of explain to you, Zach, that help you feel more confident before we do request for the approval? Any objections are going to come out right now. Well, I want to think about it with my wife. I want to do this. Or I'll say, do you want me to show you any other premiums or situations before we request for approval? Or was that $200 a good starting point for you? Any objections are going to come out right then and there. So those are your next steps. And then you can talk about qualifying. Or another close is, hey, Zach, so I know this kind of lines up to what you need it to be for your future goals. Is there anything else that you kind of need me to go over again before we request for the approval? And again, any objections are going to come out right there, or they're going to want you to rerun the illustration, go up and down, let them know that you can adjust everything. It's completely customizable to them. Or if they want to switch accounts right here, you can also do that as well. So Zach, hey, I know we talked about splitting the money up. Did you want to keep it all in the S&P 500 where it's consistent, or did you want to split that money up? And they'll tell you right. They'll tell you. So that's, again, you can go way more in depth on the IUL illustration, which I used to do, and I used to get burned all the time because people would be too confused. So there's more stuff you can do with the IUL. Each client's can be different on what you need to touch base on. Some clients like this, for Zach's situation, I would show income with this cash value so we could see how much income he can pull out per year. But not all clients need to see that because you'll overcomplicate it and make it confusing. You just got to feel each client and what their knowledge level is with investing, with numbers, with math. Because each person's different. Sometimes it's a lot easier to have those conversations. It all makes sense to them. Sometimes if you're getting delayed, slow responses, you kind of lost them. You need to backtrack and go through it again. But for anyone else, are there any pages on here or any setup design things that I need to re-go over to help you guys feel more confident in presenting the IUL?
No, this is great.
Yeah, this was good for me because I didn't realize that this was going to be the topic, but this is going to be my focus. Is IUL leads one of my focuses? So this has been very informative. Thank you.
Yeah, of course. Again, I would get you with your upline if you want to do something more detailed on showing. Well, if everybody's comfortable, I can go further and show you what taking out policy loans is. I just don't want to overwhelm you guys with all of the 33 pages that are all in here as well. So if you guys are comfortable, I'll show you what taking out those policy loans look like. So when you talk to your clients, you can kind of show them that. Or if you guys have too much information, we can stop right here. It's kind of up to you guys.
Yeah, can we see the policy loans?
Yeah, sure. So let me change this here. Jump back in here. So policy loans, two ways you can illustrate it. If you're doing infinite banking or if you're doing retirement. I'll do retirement first because it's way easier than infinite banking. So you turn disbursements on. You click this little chart here. I always change it to age instead of year because it's easier to remember. Always do it short, 1 year, because it will do it. Just do it short 1 year. You'll see when we get to the next thing. For the end, how long are they going to want this retirement income? If they want to the maximum till age 120, you can do it that way. I'll normally do it till age 85, 20 years or 25 years. Is normally all I'll do because that's age 90, age 85, and most life expectancy isn't there. So it'll show the shorter years you do. So if you do 20 years, which would be 85, obviously the more income they'll be able to take out. If you did age 90, which is 25 years, they'll be able to take out a little bit less. So again, it just depends on what your client thinks. And they'll joke with you. They'll be like, well, damn, I don't plan to live till 90. So why don't we do it like this? And like, just joke with them and agree, be agreeable and go with it, right? Um, Especially if they're doing that, that's a good sign. So that's all you do is change the age to where they're going to retire. If they want to retire at 65, do it 1 year short. If they're going to retire at age 67, do this at 66, and this will change to 67. And then you will click calculate one more time. You guys here. And spend time in here on your own. I've written myself like 10 different test IUL policies on myself. I've done it on F&G as well, just so I could get familiar with how to set up everything. So when I do meet with those clients, I know how to do everything inside and out, backwards, left and right. So when you do the loans, it does take a while to calculate because it's doing off of projections. So again, this is a time where I build that report. But any questions so far for anyone else while this loads? Bingo. If they're on cell phone, always blow it up because they won't be able to see it, especially if you're on a big monitor. So I recommend blowing it up. Ask them if they can see it as well. Take care, Mark. So again, illustration's the same. The It's on page 26, 27 is where the cash value starts. You'll learn that once you start doing this a while. Oh, actually, it's page 26 over here. Oh, nope. I added more because of the policy loans. Okay. So right here, let me get my marker back. When I draw on the screen like this with my clients too, it makes it super easy for them to know where to look because there's a lot of numbers, there's a lot of information. So if you're screen sharing uh, on Zoom, always use this draw tool so you can help direct and steer your client's eyes on where to look. So here we're looking here. This is where your disbursements are. This is where we're going to get that retirement income from, and it's going to come from that cash value. If you guys are running crank wheel, I'll also turn on my other monitor Zoom screen share to myself so I can draw so they can see it still as well. So I do it both ways. I think the drawing is super effective. So we'll scroll down to that retirement age. Oh, I forgot one thing. Sorry. When they go to retire, you're going to want to turn off them investing into the policy. So that income is, or they're still investing into the policy, you want to turn that off. So let me go back in here. You want to go to where they're paying right here. And then at age, you want to go 64 when they want to retire. And then 65 onwards is going to be a goose egg because they're not going to invest into the policy anymore. So that is on the Sol 4 page. And again, this is still set up at the maximum funded. I like to show the income at the maximum funded because it shows more income. And then disbursements, again, you're going to set up age, the retirement age, do 1 year back, however many years, 20, 25, 30 years, solve for maximum, and then you're going to calculate. So what this does is stops them investing into the policy at when they go to retire and start pulling income out, essentially. Okay, let's see here. Wait for this to load. And normally run the presentation if I'm not doing the PowerPoint first, just run straight through the actual presentation. Takes 15 to 20 minutes, so it's not super, super long. And then another maybe 20, 30 minutes to write the actual application. So I'm still running about 45 minutes to an hour per client, again, depending on their questions, kind of things like that. Okay, blow this back up for you guys. So again, we're looking over here for that retirement age. And Zach, look at that. You're actually going to make more money in retirement than you do now. So set up for, what do we do, 20 years? you're going to be able to pull out $116,000 per year, Zach, tax-free, for 20 years. So if you guys do the math on that, this is how infinite banking kind of comes into place. Calculator. And I'll show them I'll do the calculator right on the screen with them too. So I'll do 116,216 times 20 years equals 2.3 million. And Zach, if you look at age, what did we do it at? Well, it's coming out at age 68. So at age 68, you only had 1.5 million, but you're able to take out 2.3 million. That's the power of infinite banking, and that's the power of the IUL, because you can still compound when you take that money out. When you take your money out of your 401k, your Roth IRA, your regular IRA, however much money is in there is how much money is going to compound. Only the IUL compounds like this. Another cool thing, Zach, is this number right here. From the day you started this, let's say, hey, Trey, let's get this thing going. I qualify. This is super cool. From now till when you stop paying into it, you would have invested $407,000 and you took out 2.3 million without having a chance to lose money. That's remarkable if you ask me. What do you think about that, Zach?
Yeah, I'm decent at math, and that's math I can't complain about.
Right. That's like 4 or 5x your investment, tax
Yeah.
free again, which is super stress. I would stress that tax free notion because they're pulling that money out of they pull out 116,000 out of their 401k. They're going to have to pay 30% taxes on it at least. So they're not going to take home that 116. If they want to take home that 116, they're going to have to pull out like 150. So that's what looking like taking out the policy loans look like for retirement. And it's always going to be more than what the cash value is because of the infinite banking, and the cash value stays the same and compounds more than that surrender value. And what's also cool about this, guys, is let me clear these drawings out. Back over here to this non-guaranteed column, once they start taking out income at, let's say, age 87, they have no more loan balance available, but their family will still have $135,000 in death benefit, which is obviously important because that's the whole point of doing this is for that life insurance. Which even if they live till age 97, it's slowly going to trickle away, but they will still have life insurance for the rest of their life, even after using all 2.4 million in that cash value. Pretty cool, right?
Love it.
And that's why I like the IUL, because it does crazy things, especially if you set them up properly and can get them funded and running. Now, it will do the same thing if we set it up at maximum funded from the get-go. Just the numbers are going to be a lot less because we're only investing $2,400 a year. We're not investing $10,000 a year. So stress that to clients too when they want to start with a lower budget. Be like, look, we're only going to be investing $600 a year, $1,200 a year. Yeah, you're going to be able to do this, but it's really going to be more effective if you can do those higher numbers when you get those work bonuses, tax returns, and things like that. That's where you're going to see those big numbers. And that will kind of put into perspective on what they need to do to set themselves up for life, essentially. Does that make sense, guys?
Yeah, absolutely. Thanks for this, Trey.
Cool. Yeah. So, I mean, that's more than what I normally go over with the IUL with Mutual of Omaha. So, if you guys have any questions, just ask your upline. If you guys need any documents from me, I can send those to you as well. Yeah. So, hope this helps you guys feel more confident with presenting IULs and kind of going in and knowing how to set them up, what's important and what's not important. Kind of going through those and kind of setting your customers' expectations up. But thank you guys for your time tonight as well.
Thank you, Trey. That was amazing.
Thank you.
Cool. Yep. No worries. See you guys next week.